For decades, the housing market has continued to defy economic logic, with home prices rising faster than wages, incomes, and even yield. The average American household's monthly mortgage payment is now nearly 40 higher than it was in 2006, just before the Great Recession. According to data from Zillow, between 2012 and 2022, US home values increased by over 90, while median household income rose only about 25. Experts point to low interest rates as a primary driver of this phenomenon. The Federal Reserve has kept short-term rates at historic lows since the financial crisis, reducing borrowing costs for borrowers and making it easier for them to take on more debt. But beneath the surface, warning signs have been flashing red. Housing affordability metrics are now worse than they were in 2006, despite a massive influx of new homes being built. According to a report by Redfin, nearly 60 of homes sold in the US last year went for above asking price, a phenomenon known as price pressure. This is a classic sign that a bubble is forming. Some economists have begun sounding alarms about the housing market's vulnerability to correction. Nouriel Roubini, the renowned economist who predicted the 2008 financial crisis, has warned that as home prices are now overvalued by nearly 30. If he's right, and historical patterns suggest he might be, we could see a correction of up to 20 or more in home prices. The implications would be catastrophic. Millions of homeowners would suddenly find themselves underwater on their mortgages, facing the very real possibility of foreclosure. The effects on local economies, already reeling from high inflation and stagnant wages, would be severe. But the question remains, what happens before? According to data from the National Association of Realtors, median existing home prices have increased by over 70 since 2012. This remarkable run-up has been accompanied by a concomitant decrease in affordability, with the average American household now dedicating nearly 20 of their income towards mortgage payments alone. Meanwhile, the Federal Reserve has maintained an ultra-loose monetary policy for an unprecedented period, effectively subsidizing housing market growth through artificially low interest rates. The consequences of this have been multifaceted. Not only has it fueled a bubble in home prices, but also driven investors to the fore of the market, transforming what was once a predominantly owner-occupier space into a bastion of speculation. Pause, 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 yourselves, pause, pause, oh, 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 no. Mo. In particular, institutions such as Fannie Mae and Freddie Mac have played a pivotal role in facilitating this speculative frenzy by providing favorable financing terms to would-be borrowers. And it's not just institutions. Individual investors, whom are a professional trader, real estate operators, now comprise an estimated 40 of all home borrowers. And this to still tomorrow. Furthermore, the impact of these developments has been felt far beyond the nation's suburban cores, with previously stable neighborhoods in cities such as Phoenix and Las Vegas experiencing a sharp appreciation in value over the past decade. The implications are profound when prices inevitably crash, and there is little reason to doubt they will. Millions of homeowners stand to lose their shirts on what may well be worthless paper. In this sense, the question isn't if, but when. When will home prices collapse by as much as 20? As we delve deeper into the world of real estate, it becomes clear that home prices have been artificially inflated by a complex web of factors. One key development is the rise of private equity firms investing in single-family homes on a massive scale. Companies like Blackstone and Invitation Homes have accumulated hundreds of thousands of properties across the country, transforming them from individual residences into lucrative investment vehicles. This trend has contributed significantly to the suppression of home prices. By buoying up large numbers of homes, these firms create an artificial shortage of inventory in local markets, driving up prices for remaining homeowners. According to a 2020 report by the Urban Institute, private equity-backed single-family rental companies own over 200,000 properties across 22 states, with a combined value exceeding $70 billion. Furthermore, government policies have played a crucial role in sustaining this market. The Tax Cuts and Jobs Act of 2017, for instance, allowed investors to deduct mortgage interest on secondary homes used as rental properties, effectively rewarding speculation over traditional homeownership. This move significantly reduced the tax burden on private equity firms and other big-time real estate investors. Additionally, government-backed agencies like Fannie Mae and Freddie Mac have also contributed to the market's instability by buoying up mortgages at inflated prices, thereby creating a false sense of security for lenders. This artificially low interest rate environment has enabled consumers to take on more debt than they would otherwise be able to afford, further fueling the housing bubble. These factors combined have led to the creation of an unsustainable market where home prices are artificially propped up by external forces rather than genuine economic fundamentals. The housing market's resilience has been a hallmark of the U.S. economy for decades. However, beneath its fade of stability lays a complex web of factors that ultimately contribute to periodic price crashes. One such factor is the role of investors in the market. According to data from RealtyTrack, investor purchases accounted for nearly 20% of all single-family home sales in the United States in 2020. This influx of capital has helped drive up prices, but it also creates a fragile foundation. When investors become overly optimistic about future price appreciation, they may bid up prices to unsustainable levels. This phenomenon is particularly evident in cities like Los Angeles and San Francisco, where tech giants and private equity firms have poured billions into real estate investments. Proximity to these hubs has led to skyrocketing home prices, leaving would-be buyers priced out of the market. But what happens when this house of cards begins to crumble? The consequences are far-reaching.